If we look at what we have been discussing in the last minutes and what we have been talking about all this time, at the end of the day, it all comes down to the fallacy of synchronized growth. We have been hearing from international bodies, from central banks, that we were living in a synchronized growth territory, that we were seeing developed markets grow faster than what was typical of developed markets, while emerging markets were also growing in tandem, and that the economies were much healthier, that everything was much better, and that 2018 was a year in which we would see the confirmation of that synchronized growth trend and the reflation trade. Well, guess what? It wasn't the case. The case actually was that what we were being told was synchronized growth was synchronized debt growth. And what that massive increase in debt that led to the highest level of global debt to GDP in history last year was creating massive problems, internal problems in many economies that were getting used to cheap and easy money. And a very small reduction, completely minuscule and completely moderate reduction in the balance sheet of the Federal Reserve of less than 260 billion has created this reckoning that the reality that we were seeing globally was not a reality of higher growth, better productivity, and more positive surprises, but the reality that it was just a debt-led bump up of a much clearer trend of secular stagnation. So what happens is that we will likely see solutions that, instead of cleaning the system, that will not be massive crisis, will be solutions that will basically lead to more secular stagnation. Why? Because what most central banks, what most governments will be doing will be to try to avoid the pain, avoid the pain of improving the economy. What will they do then? What they will likely do is to perpetuate the problem. Therefore, this constant bailout that I was mentioning before of China, and the constant bailout that we're seeing, for example, of the less productive economies in the Eurozone, is actually more likely to be the solution and the exit. And what that leads is higher debt, because capital misallocation of capital is actually incentivized and malinvestment is actually incentivized, low interest rates remaining way below the curve and central banks being way behind the curve, and at the same time that potential growth is being eroded.